at is the pair US dollar versus MXN. And the reason why I prefer, it's not that I prefer exotics over the more liquid pairs like Euro US dollar and pound. It's just that I pick volatility over liquidity. And the reason is, even though they're a bit more expensive and the spreads is a bit higher, there's a reason why. And the better option of having more volatile pairs on your watch list and your trade list is that you aren't so over leveraged. You make more money to compensate the leverage and to compensate the size. So as your account grows bigger, I don't think the solution is to increase your leverage or to increase your position size, and that can be quite dangerous for many reasons. Obviously, leverage being as dangerous as it is, I pick more volatile pairs personally. That doesn't say you have to, but it's just the reality. And if you want some more insight into it, um, there's a video that was done by Anton Creel, and he talked about the over leveraging of retail traders. And he was saying that basically when their accounts are growing, they find it more difficult to trade because now they have to increase their size or their leverage in order to start making more money, right? And so he just says the solution isn't to try over leverage and over position to get volatility. The solution is to just trade more volatile pairs. And the reason why is that brokers specifically make exotics and more volatile pairs more expensive to discourage you from trading them because it's less liquid for them and costs them a lot of money to hold the positions and to open the positions. Anyways, what am I looking at? So currently, I'm looking at the position here. This would be a mirrored version of a rising wedge. So if this pattern doesn't look familiar to you, it's because it's the mirrored version of a rising wedge. If you were to place a mirror right in the middle here, right, you'd get the same pattern on this side as a rising wedge, and then you'd be selling, right? So that's done. We've seen the price come to this point here, and then this point again, and then nearly touched this point Friday when the markets closed. I was looking for a sell in this area, but unfortunately it didn't touch as I had anticipated. So what I'm going to wait for is just another pull up through, and then that's when I'm looking for a sell position. And my target is this area here. That's when the rise actually started, so that's where my target is going to be. And obviously it will be most likely a weekly trade, so it won't last me too long. But the reason why I'm not so concerned with that is because I already have a main trade on this pair, which is this was the rising wedge that I was talking about. If you put a mirror, you would see the rising wedge, right, which was up here. And then I got in at this point, this entry here, same touch here, same touched here, same touch here, same touch here, but there was a divergence at this area here. There was a divergence, and then the crossover between the 89 moving average and the 8 moving average signaled to us that we were heading for a downtrend. And so what this would merely be is just a pullback and not an uptrend. That is the assumption, hopefully. And if we zoom in, it didn't touch quite perfectly. So if it does continue to go down, I'm not going to try enter. But this does look like a touch. So depending on what Monday looks like, I mean, I can say it's a touch really, but if it does spring up, I will be looking for a sell. That's if it does spring up and does one more push up, then I'll definitely be looking for a sell. But as of yet, I'm just chilling on it, waiting and seeing, because it didn't look like it actually touched. Yeah, it just missed by a bit. So it's possible that this could actually just rise to the top or come down to this area, this 89 moving average, and then bounce back up. But I don't want to get in too early, because obviously if you're trading a bigger position, then you're just paying for spreads and then you'll get knocked out. You'll get taken out, especially if you enter late. The worst thing is to try enter late once a position has gone, once an entry or an opportunity has gone. The worst thing is to now try enter once the market has already gone. You're just paying for extra spread and you'll just get knocked out. So that's another position I'm looking at currently.